Welcome to TheoTrade. This is Don Kaufman. Here we are. It's January 31st, 2018. FOMC came out today, sparked a little bit of volatility inside of the broader markets over here. So, yeah, it's Janet Yellen's final meeting with the FOMC, but she got one good laugh in over here as the S&P started to sell off a bit. Now, we're not really seeing any extraordinary volume. We're really not seeing any extraordinary volatility per se, but we do have about 45 minutes left in the trading session. But here on this Theo Night video, well, let's talk about what's in play right here, right now. Let's talk about what's in front of us, not necessarily what's going on, okay, this second. When I say in front of us, well, hey, people, we have the earnings extravaganza of a lifetime coming up inside of really about the next 24 hours. So the likes of Microsoft is going to report after the bell today here on Wednesday. By the time you're actually watching this, Microsoft has already reported. Facebook's going to report after the bell. But tomorrow, Thursday after the bell, it's going to be like super monsters of tech Thursday. You've actually got Amazon, Google, and Apple all reporting. And I mean, again, we're talking about, if you want to look at this from a market cap perspective, and, you know, just hold on to that thought for here for a second, because we're going to look at a few of these underlyings. We're going to talk about a couple of the trades on these underlyings. All right, you got Apple. I mean, come on, this thing's just shy of $1 billion market cap, right? Throw a little Facebook in there. All right, where are we at on Facebook? Oh, just about $540 billion market cap. So do some math. We're somewhere in the neighborhood right now of about $1.3, $1.4 trillion of market cap. Throw a Microsoft in there. Oh, yeah, let's get the party started with Microsoft. Throw another $700 billion. So we're already up to about $2 trillion of market cap. But wait, there's more. Yeah, you forgot about Google. Now, Google's split into two different parts. And Google, that's sitting in a market cap, again, not too far away from Apple over there. So now we're up to the neighborhood. It's about, again, $700 to $800 billion dollars inside of Google. So now we're up to about 2.8 trillion. Oh, and the mother of them all, and this is the one that's just been exploding to the upside. You got another, again, $700 billion in market cap. So let's just call it, we're well over $4 trillion of market cap all reporting. That's scary because, you know, you keep hearing there's like, you know, $8 trillion of market cap that have been added to the markets inside of the last year. And then you realize, yeah, but there's only 4 or 5 stocks that are really even involved in much of those market caps over there. Nevertheless, what I want to talk about here and now isn't necessarily just the volatility, because again, a lot of the volatility in the next 24 to 48 hours and really through the end of the week is going to be predicated specifically on what goes on around these earnings. And the one thing I want to talk about with earnings trades, and I want to be very, very concise with this, is first and foremost, what can you even do around earnings? I mean, it's a fair question. So you're a trader and you want to trade earnings, and everybody takes a look and they go over, you know, to like a trade tab over here. And I'm just close up this left side bar so you can see this. So they cruise over to a trade tab and they go look at the right hand side and they look at the implied volatility like, yeah, it's all puffed up. You know, oh, there's a lot of implied volatility. I mean, you kind of get excited because, like, look, Amazon, that's almost $100 expected move. Right? You're trading like almost 100% implied volatility for the next 2 days. And it seems incredibly enticing to want to sell that. But what you have to realize, like, you know, when it comes to an earnings announcement, there isn't necessarily, you know, let's not call it high volatility or low volatility. The volatility in Amazon, or really anything that's liquid, and liquidity is a critical aspect, but anything that's liquid, the volatility is just a function of supply and demand. That volatility that's labeled here specifically on thinkorswim, the way that that's derived, it happens to be like kind of an averaging formula of the implied volatilities of many of the options. And for those of you that don't speak total geek with implied volatility, in the end, all implied volatility is, okay, all it is bids and offers. It's supply and demand. So when people look at this, they go, those options, they are juicy. I can't wait to go out and to sell those options. The reality is, all right, this is buyers and sellers that determine these implied volatilities. That expected move is set at $100 for a reason, okay? Because the buyers and sellers agree. Again, there's an incredible efficiency that revolves around the trade. And allow me to show you just that. So, at TheoTrade in the chat room the other day, I was talking, substantially about Boeing. So Boeing, it just had its earnings this morning, okay? And it's right now, it's moving $15 and about 39 cents and change. It's moving around a little bit right now. And one of the reasons I like to record when the market's open is because, hey, we're traders. That's what we do. So with Boeing, right now it's moved about $15. And again, the earnings announcement is all but over. But what was it supposed to move? And for that, we go back to what? The previous day's close. So let's take a quick glance right here at the previous day's close, and then we're going to look at the expected move. Remember, the expected move is just another way of saying that's what the option market says. The option market dictates, not some weird formula, but the option market dictates right around a $15.85 move was expected. The actual move is $15 and basically 85 cents. It's ridiculous. So you have to realize if you went out and you were going to trade earnings, okay, like this, I'm going to make this as clean as possible. But if you're going to trade earnings, for the most part, I'm going to break earnings down into a distribution. And what can you do? So there's going to be earnings. It doesn't matter whether this is Boeing, whether this is Apple, whether this, is Facebook, whether this is Microsoft. It just doesn't matter. Okay, we can call this stock. We can call it stock. All right, it just does not matter what the underlying is. And let's say that stock has plus or minus, we'll call it $8, right? So what can the stock do? It means the stock's supposed to go up about $8 or down about $8, right? So it's plus 8 or minus 8. And it's supposed to stay in that range about 68% of the time. But there's a reality to this, okay? And the reality is if you ran, by the way, thousands and thousands of trials on this, it's pretty amazing. You're going to find out it's almost spot on. But in more recent markets, the efficiency of trade, especially in the very liquid products, the efficiency of the trade has actually been driving stocks right to the edge of what's expected. Okay, and we're seeing this time and time again. Like Boeing was supposed to move $15. Oh, lo and behold, it moved $15. Now, earlier today, it was up at as high as 19. It sold off a little bit. It laughed. It cried. But in the end, it did what it was supposed to. And we're seeing this more and more often. So in an efficient marketplace, okay, what can you really do? Well, there's 4 trades, and that's it. And I don't want to hear like, well, I could do a calendar spread, and I could do one of these, and one of these, and one of these. It's a chicken. It's a duck. It's a triple naked backflip trade. Listen, I've been doing this business a long time now. There are calls, there are puts. You can buy them or you can sell them. You're right? Okay? You can get bullish. You can be bearish. Okay? You can actually be neutral, what we'll call short, or neutral long. Now, I'm actually going to take you into a trade for each of these. So you could be a bull, you could be bear, neutral short, neutral long. Let me describe that. Okay? With this distribution curve, what's bullish? You think the stock is going up. Good. We'll build a bullish trade. Bearish. What do you think? The stock is going down. Good. We could build a trade for that. What's neutral short? Neutral short is saying, I'm going to adhere to what's expected. That says, I think we're going to stay inside of the expected move. And you actually sell options in some way, shape, or form outside of the expected move. So if it says it's supposed to move $8, you go just outside the $8, you sell some premium, something like an iron condor. Or you could use calendar spreads or yada, yada, yada. I could give you, again, there's 10 different trades, all for being neutral short, that amount to the exact same thing. And then you could be what's called neutral long. What's neutral long? That's where you actually buy premium. You can buy premium. It's almost hard for me to say that, right? You could actually buy premium and hope we actually move huge, which can happen. Now, there's an important point to be made along with this. What decision are you going to make? And I'm going to give you a quick example here in terms of Microsoft. So In Microsoft, and I've been watching this for a few days, and I made this point the other day on one of the videos, in Microsoft, if you look at the implied volatility, okay, for a year, we're actually at one of the highest implied volatilities. In fact, we're at the highest implied volatility recorded since all the way back until early, okay, 2016. So maybe in Microsoft, you might want to be a seller of premium, all right? Then we switch around over here and we come into Amazon. So Amazon, look at the volatility in there. It's all puffed up. Doesn't necessarily mean that Amazon's going to stay in that 100-point move. But let's use Amazon for an example. So we open up the 2-day options. Now, if you just want to take a little bit of risk, not a whole lot of risk, and you want to get bullish, how can you get bullish in here? Listen, just use something, okay, like a $5 wide spread. That's it. Here is a $5 wide spread for a $2.38 credit. What can you lose? $2.38. What could you make? Most you can make in a $5 wide spread is $5 minus the credit over here. So you're looking probably about, $2.60 of profitability. That's a bullish trade. It's a bullish trade, but I'm capping my upside. What? It's going to have a $100 move. Okay, but the reality is, do you really want to bank on that? Do you want to go out and buy a $50 option for the next 2 days? Because if you're wrong, that $50, that's toast. All right? What's a bearish trade look like? Oh, just do the opposite. Okay? The opposing of this. Now, for a $5 wide spread, I would not pay more than $2.50. There's a bearish trade. So, again, we just did a bullish trade to bearish trade. Now, those are fairly safe ways, and there's 6 different ways you could probably get bullish and 6 different ways you could probably get bearish, but don't tell me that there's going to be 20 different ways to trade earnings, because there's 4 ways to trade earnings. You're bullish, you're bearish, you're neutral long, or neutral short. Now, we did a bullish and bearish. Let me actually talk a little bit about the neutrality trade. The neutrality trade, we're going to have to open up a whole lot of strikes. We'll open up a few strikes. We'll look $100 move. Well, behold, I'm probably going to have to open up a whole lot more strikes. Let's just go to all. We're going for it. I mean, this thing, you're going to have to go about $100 out of the money. Okay? It's a behemoth. So you're looking at the 1550s, 1560s. I mean, far be it for me to say this, but that's getting a little scary. I mean, you're scary far out of the money. Look how far out of the money we are, and there's still premium. Okay? There's still a whole lot of premium out here. And again, I'm just going to whip this together in about 2 seconds just so you can get a feel of effectively what you can do. And I'll come over here to the 1575s, right? 1575s. Let's make this one a big one. 1585. It's $10 wide. So look at how much premium. By the way, if you wanted to get bearish, you could also just come out here and, sell premium all the way out at the 1575, 1585. It's $1.62 a credit. On the flip side of it, and we can scroll all the way down, and again, you'll be scrolling here for quite some time, but on the flip side of this, and again, if you want to make this equidistant, do some quick and dirty math. And again, just to show everybody how to make it equidistant, for the most part, you take this 1575 strike, okay, take the 1575 strike, subtract it from where the underlying currently is, which is 1457, equals $118 out of the money. Yes, we're $118 out of the money. So take that 1457, subtract what? $118. You want to be somewhere around what? 1339. Woo, this is far out of the money. So if I wanted to make this again equidistant, I could then sell the 1340s, maybe turn around and buy the 1330s. All right, and we'll go ahead and analyze this trade. I'll throw it into the risk profile, and there, people, is an iron condor. Now, this is an iron condor. It's a $10 wide call spread, a $10 wide put spread for about a $3.15 credit. What do you do after you put this on? Well, there's only one thing you can do. You can pray. You can pray that we stay in here, or you're going to lose $7 on here. Well, let me be specific. $10 wide spread of which you collected $3.15 up front. You have, okay, $7.85 of risk, which could be a lot for some of you. So you have to recognize this is what we term neutral short. You're banking that we stay inside the expected move. What would neutral long look like? Something like a buying of the iron condor. And you could do that if, again, you think we're going to move big. All right, So we've got huge earnings coming out. Lots of people want to trade those earnings. I wanted to give you a little bit of an earnings extravaganza in what is some volatility in the marketplace. But again, please don't let anybody tell you there's some huge advantage per se of trading earnings. You got to get it through your head. There's 4 ways to trade this stuff. You're bullish, you're bearish, you're neutral long, or neutral short. Thanks everybody for joining us at TheoTrade. Good luck during some of these earnings in the coming days. Have a good evening. Bye-bye.